So we're going to take a look at overview of HFA Advantage. So when you're using ADFA's program and a conventional loan, the underlying first mortgage that you're going to be using is called the HFA Advantage. And it's a great loan program that has a bunch of benefits and features to it. First of all, it allows you to go to 97% loan to value and up to 105% total loan to value using down payment assistance and closing cost assistance. We defer to the HFA for their income limits in lieu of Home Possible's area median income limits. So if you're familiar with Home Possible, that's our other low down payment assistance program. That one is capped at 100% of the area median income. ADFA's program actually is higher than 100% of the area median income. So we defer to the HFA to set those income limits. The HFA determines the homebuyer education requirements. We don't dictate that. And then probably the biggest selling feature of the HFA Advantage loan is that it offers charter level mortgage insurance. And we'll take a deeper dive into that. But the charter level mortgage insurance is roughly half of the standard mortgage insurance requirements. And that really makes a difference in your borrower's payment. And sometimes, it's the difference of $150, $200, $300 to your borrower. And quite often it's the difference from your borrower getting approved and not getting approved, especially when you're pushing those debt ratios. And we're going to take a look at this charter level mortgage insurance a little bit deeper, and then we're going to talk about ways that you can use that mortgage insurance to your benefit, talking about things like split premiums and single premiums, which most loan officers aren't using right now, mostly because they just don't have that comfort level to be able to offer a split or single premium. But we're going to talk about that, and we're going to let our folks with Essent also talk a little bit about that as well. There's no minimum loan to value, so we do have a 97% maximum LTV, but they can still put 10% down and still take advantage of the charter level mortgage insurance and the other benefits and features of HFA. There is no minimum borrower contribution, and there's no reserves required, no minimum reserve. With that said, I do want to, especially with the no reserves, although it's not required, if your borrowers are pushing the limits, if they're pushing that debt ratio, if they're low on the credit score, if they're high on the LTV, those reserves, although it's not required, quite often makes a difference in getting your loan approved. And we've had loan officers using ADFA's programs who've called us because their loan didn't get approved. And we suggested that they restructure the loan so that they have more reserves. In one case, they were putting, I think it was 10% down, but they had no reserves. So rather than put the whole 10% down, they put 5% down, put the rest as reserves, and then their loan was approved. So it's little things, little tweaks like that that can make the difference between getting your loan approved and not approved. And if you get stuck on a loan, you can certainly reach out to us, and we'll take a look at that LPA feedback certificate and make these kind of suggestions to you. And after a while, you'll start picking up on that, and you'll know how to restructure that loan to give it the best shot at getting approved. There's also no credit fees, also known as loan level price adjustments. There are no loan level price adjustments for this program. And then a new feature that we added, borrowers can now own other property. And sometimes it's contrary to what you might think of affordable lending. Well, they already own another property. Why do they need help buying another property? Well, there's many reasons why they may own other property. The most common is that they inherited the property with 5 of their other siblings. They can't sell it, but now they're considered a homeowner. So cases like that, other reasons, divorce, they split up, one stays with the property, the other one doesn't. They're still on title for many reasons. So those are the reasons why we made this change to allow borrowers to own other property. But even if they bought that property, paid it off, and still own it, they can still use this program. And then it's a great alternative to FHA financing. So we don't sell against FHA. FHA is a great program for certain borrowers. Mostly those borrowers who are pushing the debt ratios and with the lower credit scores. But we want to make sure that the FHA is not your default, it's not your go-to. We want to make sure that you're really taking a look at FHA versus conventional And we'll take a deeper dive into that because quite often conventional is the better way to go if they can get approved for conventional. And then the majority of housing finance agencies either provide true grant funds or an affordable secondary financing as part of their down payment assistance program. And like I mentioned before, that will allow you to go all the way up to 105% total loan to value. Quite often you can layer multiple down payment assistance programs. For instance, if you use ADFA's programs and maybe a local municipality is offering a down payment assistance program, you can put those together as well. So there's lots of creative ways for you to structure your loan to get that borrower approved. So here's a head-to-head comparison of HFA Advantage to FHA. Like I said before, we don't sell against FHA. Sometimes FHA is absolutely the right product for your borrower. But if they can go conventional, these are some of the reasons why they should. First of all, mortgage insurance ends when the loan to value is less than 80%. On the FHA side, the mortgage insurance stays for the life of the loan. So I mentioned earlier, even at a modest 2% appreciation, your borrower will be at 80% loan to value around 65 or 66 months versus FHA. They're stuck paying mortgage insurance for the life of the loan. As I mentioned before, also charter level mortgage insurance, and we allow monthly, single, and split premiums. On the FHA side, not only do they have a monthly mortgage premium, but there's also an upfront premium that they're going to have to pay. Quite often, when they're doing that upfront premium, pretty much always, you're financing that upfront premium back into the loan, thus reducing the equity that they have in their property. MI insurance is only required if the LTV is 80% or higher. On FHA, even if they're at 60% loan to value, they still have to pay mortgage insurance. And then also, as I mentioned, there's no upfront mortgage insurance premium versus FHA, where it's also upfront, added to the principal and amortized. This is what the charter level mortgage insurance coverage is. So if you're between 80 and 85%, the standard mortgage requirement is 12% coverage. With the HFA Advantage mortgage, it's only 6%. That's half. 85 to 90, it's 12% versus 25% standard. That's more than half. And then between 80 and 90, 16% coverage versus 30. And when you're up at the 95 to 97, 18% coverage. So it's a huge reduction in monthly payment versus standard mortgage insurance. So again, as I mentioned, even if your borrower doesn't need the down payment and closing cost assistance, they can still use the ADFA program just for the sole purpose of taking advantage of this lower mortgage insurance. It's going to save them, in some cases, like I said, a couple $100, $300. So this is a head-to-head scenario of conventional versus FHA. You all should have one of these handouts on your table, so if you want to follow along, this really illustrates the benefits of using HFA Advantage. So we have a few assumptions here. In this case, the purchase price is $175,000. We're at 18% MI coverage because they're at 97% LTV. It's a 30-year fixed rate mortgage. We're assuming roughly $400 in taxes and insurance, 7-year FICO score, and then 2% annual appreciation. And we estimate, based on 2%, that the PMI is going to be dropped in 5.7 years. As I mentioned before, right now the national average is over 5% appreciation, so that PMI would be dropped even sooner. In this first scenario, this is just a regular monthly mortgage insurance premium. And what we see here is we're comparing scenario 1 to FHA over on the right. So in this scenario, we're at 97% loan to value. On the FHA side, we're at 96.5. Our rate here is actually higher. It's 5.875 versus 5.625 on the FHA side. But what you're going to see is that interest rate doesn't always correlate to payment. And especially when you're talking with first-time home buyers, what are they most sensitive about? Interest rates. Why? Because basically they don't know what to be sensitive about. Someone told them you need to have the lowest rate, and that's the most important thing. Certainly that's not the case. And we can see even in this illustration that even though we have a higher interest rate, the payment's going to be lower. So going down, the base loan amount is $169,750 versus FHA's $168,875. There is no upfront mortgage insurance cost. versus FHA where they're gonna be paying $2,955 in upfront mortgage insurance. So now that's gonna increase the loan amount. On our side, it stays the same, $169,750. On the FHA side, now that increases the loan amount to $171,830. So you're increasing the loan amount, reducing the equity in the home. The down payment requirement on the conventional side is less, $5,250 versus FHA where they're coming in with $6,125. So more down payment and still a higher loan amount. So the monthly mortgage insurance premium, because they're taking advantage of that charter level mortgage insurance, it's going to be $96 versus the FHA of $119. The principal and interest payment, $1,004 versus $989. So P&I is less on the FHA side. Taxes and insurance are the same across the board, but then take a look at the monthly payment in year one. So it's $1,500. On the FHA side, it's $1,508. So it's only an $8 difference, but it's still lower than FHA, even though the interest rate is higher. So you have these rate sensitive borrowers, if you can educate them and show them that rate doesn't always correlate to payment, that helps them feel a lot more comfortable with taking a slightly higher interest rate. So again, we took a look, the monthly cost savings is $8, but the monthly cost savings over 5 years is $5,760, and that's because they didn't have to pay that upfront mortgage insurance premium. And then the 5-year MI savings compared to FHA, the first one was the cost, $5,760. The savings is $4,095. That's real money to your borrowers. That's real $4,000 that they're gonna be able to use towards other things, fixing the house, buying appliances, paying the bills. When we're looking at, and then again, after 5.7 years, that payment goes down to $1,404 for the remainder of the loan. Whereas the FHA side, it doesn't go down. So we've dropped the PMI, their payment's gone down after year 5.6. In the second scenario, same assumptions, same interest rate, but in this case, we're using the single premium to buy out that mortgage insurance completely. So we're paying it up front. That's not, it really depends on what your borrower's goals are. If they plan on moving out quickly, maybe that's not the best option. But as we saw earlier, most borrowers plan to stay in their home for 10 years. And in that case, it certainly makes sense in this scenario to purchase a single premium and buy out the mortgage insurance altogether. So in this case, they paid $3,819. That's almost just close to $1,000 more than the FHA upfront mortgage insurance premium. But then keep in mind that that's the first and only payment that they're gonna make to mortgage insurance. And another thing to keep in mind is you can use down payment and closing cost assistance funds to buy out the single premium. I don't know if we ever got clarification on the ADFA funds, if we were able to use those for mortgage insurance, but.
I don't think we've got an official word.
Okay, so we'll get clarification on that, but even if you're not using the ADFA funds, if you're using the other down payment assistance program, you certainly can use those funds to buy out the mortgage insurance altogether. If you're worried about QM, the QM threshold is higher when you're using HFA Advantage, so it's 5%. So generally, you're not going to have any QM issues as well, even though you're buying out that single premium mortgage insurance. And that's an advantage that you won't get on a standard conventional product. So now our total loan amount is $169,750. The down payment is $5,250. There is no monthly mortgage insurance payment. So if we drop down to the total monthly payment on scenario 2, $1,404 versus the FHA of $1,508, we're saving our borrower $104 a month in mortgage insurance premium. And that quite often is the difference in getting your loan approved and not approved. If you're pushing those debt ratios at 45%, switching from a monthly to a single premium might help you get your loan approved because now you're lowering those debt ratios. So that's what I'm talking about getting creative with your mortgage insurance options. So the monthly cost savings is $104. The monthly cost over the first 5 years is $38.19 because they bought it out in day one. the 5-year savings compared to FHA. So now in this second scenario, we've saved our borrower $6,036 versus FHA. And then again, the mortgage insurance stays for the life of the FHA versus scenario 2, where they don't have a mortgage insurance payment for the duration of their loan. So these are just some examples of how you can use mortgage insurance creatively to get your loans approved. Now again, the number one thing here, especially in this county, is in this scenario, we use an assumption of 700. So these numbers wouldn't quite work for significantly lower credit scores, but certainly if you have a borrower that's 700, this is something to consider. We also have the additional subsidy program. So the affordable income subsidy is available. We offer $1,500. So if your borrower is at 80% or less of the area median income, they'll get an additional $1,500 grant. It's free money, it's paid up front, and there is no repayment provision. If they're 50% of the area median income or less, we'll give them a $2,500 grant. Again, free money, there is no repayment provision, and like I mentioned earlier, you can use these funds towards buying out that mortgage insurance if you so need to, and if your borrower meets those qualifications. So great options, something to think about. Are there any questions before I go into LPA, Loan Product Advisory? Comments? No? Okay, looking good. Moving on. So taking a look at Loan Product Advisor, we know that the program changed. So prior to, I don't remember when it was January that you switched over? So prior to January, most folks were using DU. Most of you are familiar with DU. It's certainly more common to be using DU than LPA. And then in January, we switched over to 100% LPA. So we get a lot of questions about LPA, mostly because our loan officers still aren't quite used to using LPA. So we're going to take a look at what we need to do to, how to input this in LPA and see if you have any questions. Most of the questions that I get are during this LPA portion of the presentation. So again, if you have questions, please feel free to speak up and let me know if you have any specific questions. Number one here, when you're entering it in Loan Product Advisor, and yours may look different. So if you're using an LOS, the interface may look different, but the data is still the same. So first and foremost, you want to just make sure that you're selecting HFA Advantage. That's the program you want to choose from your drop-down. You will see that option regardless of which LOS you're using or if you're accessing Loan Product Advisor directly. HFA Advantage, that's the program that you want to select. And that's what's going to give you the charter level mortgage insurance and no loan, no price adjustments. Also, your LOS system may have you enter a code. If you have to enter that code, it's code 251. So code 251, product code 251, corresponds to the HFA Advantage program. So this is where we get most of the controversy. An affordable second that does not require a payment within the first 60 months can be entered in the total gift fund field located in the assets and reserves section. You do want to ensure that when the loan is delivered through Loan Selling Advisor, which most of you at that point are no longer dealing with the loan, but you want to make sure that secondary financing fields are accurate. And basically what we're trying to say is if you have down payment assistance and there's no payment in the first 60 months, rather than inputting that down payment assistance as a second, you input it as a gift. And what that's going to do is you're going to get more favorable findings. So we have something, you're going to hear this term more and more, called layered risk. And what layered risk is exactly what it sounds like, different layers of risk. And secondary financing is one layer of additional risk. You may get your loan approved inputting it as secondary financing, and that's perfectly fine. If you put it in as a second and it gets approved, great. But if you don't, then you can consider inputting it as a gift instead of as a second loan, and you have a more favorable chance of getting that loan approved. Now, I get a lot of pushback from loan officers and underwriters because they don't feel comfortable doing this, and I completely understand why. It's contrary to what you would believe. Well, it is a second, there's a note, there's a deed. Why am I not putting it in as a second? It's in our seller's guide, and I've included that section of the seller's guide at the bottom of this presentation, so that when you get pushback from your underwriters, you can either show them in the seller's guide exactly where it is, or you can certainly reach out to me or my underwriting team, and we'll confirm for your underwriters that it certainly is allowed, and help them feel more comfortable, give them a comfort level so that they'll approve that loan. So I just want to make sure everyone's clear on that. If there is no payment in the first 60 months, you can put it in as a gift instead of as a second, and you are going to get a more favorable finding more often than not. And speaking of layered risk, that's something I also want to talk about. Quite often I get loan officers that they'll give me a call and they say, well, this looks like a great loan. I met the minimum credit score. My debt ratio is at 45, I'm right there. LTV is at 97, why is my loan not getting approved? Right, I met all the minimum requirements. What's the problem here? But once we start taking a deeper dive into the actual credit makeup of that borrower, and we look at what's in that credit, we start seeing different layers of risk. One of the most common layers is that they just haven't had credit established long enough. So a lot of them have new credit. So they have the FICO scores where it needs to be, but they've only had that credit established for less than 24 months. That's probably the most common one that I see, that they don't have any long-term credit established. So even though they meet that minimum credit score, they don't have a long-term credit established. That's one layer. So if it's only that, you still might get approved. But then we take a deeper dive and we look at that new credit card that they got. And in fact, in one example here on a loan that ADFA loan that a loan officer reached out to me on, they got 2 credit cards in January and they were maxed out by February. That's the problem. You know, that's a factor. That is definitely an additional risk layer. So now we have a 97% loan, we have secondary financing, and we have someone who just got a credit card, 2 credit cards, and maxed them out. So that's what I'm talking about, layered risk. Even though your borrower meets the minimum requirements, once you take a deeper dive and take a look at what that credit makeup is, you start uncovering things and unraveling things, and you realize that the borrower is not as strong as you thought. But then again, it goes back to consumer education. Borrowers should have known that you shouldn't max out your credit cards if you're about to purchase a home. Seems obvious to us, but it really isn't always obvious to these borrowers. It's not. It's mind-boggling. It's hard for us as loan officers to realize that, but these borrowers really don't understand. So it's up to us to educate them and helping them understand that even if they got those credit cards and maybe used half of the available loan limit, they would probably be fine. But they're maxed out. They're at like 98%. They pushed it as far as they could. So these are risk layers that we have to keep in mind. Let me see, I just want to make sure I cover one more thing. So you do want to make sure that if you do input it as a gift, that it shows up in the total gift fund field in the assets and reserves section. So before I move on, any questions on that? Okay, and again, if you do get pushback from your underwriters or even your branch managers, whoever, you can certainly reach out to me, certainly reach out to my underwriting team, and we'll clarify that for them. And I do see a hand right there.
How do student loans, how are they reflected in the LP?
What do you mean how?
Well, I mean, I know if you owe more than what you originally borrowed, that's going to have an impact. Is that becoming a big problem?
Not really. What we're looking at is the payment. So it really is going to come down to if there's a payment on the credit report, that's what we're going to use. If there's no payment showing on the credit report, then we're going to use 0.5% as the payment, which is less than Fannie Mae, by the way, which they're looking at 1%. So we actually look at student loans more favorably than Fannie Mae does. Does that answer your question? Okay. Moving on. So when we're taking a look at the loan product advisor feedback certificate, I'm sorry.
I have a question
Sure,
on
go ahead.
student loans. Now, you said
then that's what we're
Now,
gonna
if
use.
it's a zero payment, would we have to use the half?
That's correct, yes.
Would you have to use the 0.5% if you had the deferred, the income-based repayment letter with?
If you have your repayment letter, then you're fine.
Okay.
Thank you.
You're welcome. Okay, so when you're looking at your feedback certificate, what are you looking for? You're looking for eligible and accept. That's what you're looking for, right? Very simple. Looking at loan product advisor feedback certificate here, you just want to make sure that you verified that you selected the right program. So in the offering identifier, you're going to see HFA Advantage. If you see HFA Advantage, you know you chose the right program, you know you're going to get all those benefits, the charter level, the no LLPA. So you just want to make sure you chose the right program. It does happen. People choose the wrong program. Home Possible, it gets approved, they think they're good, but they chose the wrong program. They just simply didn't pay attention. So you want to make sure that you're choosing HFA Advantage in the offering identifier. You're going to get some codes as well. So these codes really, they're just going to help confirm that you chose the right program. Code 81, it says only Freddie Mac servicers with a negotiated commitment, blah, 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 HFA Advantage. You just want to make sure you got 81. If you see that code 81, again, you know you chose the right program. And then a new addition to the feedback certificate we added was the area median income. So now we'll provide you with what the area median income is for that particular property that you've entered into LPA. Now we know that the ADFA program, they're not using our area median incomes. They have their own limits. But what you would use this for is to determine whether they qualify for that grant. Because the grant is based on 80% of the area median income, not 80% of HFA ADFA's income limits. So that's why we include the area median income there. Otherwise, you would again defer to ADFA for what their income limits are. The G2 code includes a total amount of down payment assistance or total gift funds that was entered into the assets and reserves section of loan product advisor. So I mentioned earlier that you can use input that second as a grant. If you do that, you want to make sure that this G2 code comes out to the same as the gift funds that you input into LPA. Now, there may be a case where there's a discrepancy because they received additional gift funds from parents or from wherever that source may be. So again, you just want to make sure that all those gift funds add up correctly. And looking at this code G2 is really going to help you ensure that you've calculated those gift funds correctly. So supporting your business with Freddie Mac resources, we have first of all, we've revamped our website completely. So it has a completely different look and feel to it. So I would invite you just to go to freddiemac.com and see what it looks like. It's a lot easier to navigate through. But most importantly, we want to make sure that you sign up for news and updates, because anytime there's a change, especially to HFA Advantage, you're going to get an email. We're not going to spam you. This is not for marketing. This is strictly to provide you with news and updates about Freddie Mac products. So it's not HFA Advantage specific, but you're going to get additional information about Home Possible and just changes that we've made throughout the year. So I would encourage you to sign up for that, subscribe. Again, we're not going to spam you. You might get 3 or 4 emails in a month of news and updates. And that's pretty much it. So certainly subscribe. You'll be updated. You'll see the changes that we've made to Loan Product Advisor. And then this is the super secret hotline. So some of you may be familiar with the 1-800-FREDDIE line. We have a team of underwriters in Virginia and in Texas that have been trained specifically on HFA Advantage. They understand ADFA's program very well, and they're available during regular business hours. But to get to them, you have to know the correct extensions. If you just call the 1-800-FREDDIE number and you don't enter the correct extensions, you will still get to an underwriter, but you're not going to get to the specific underwriting team that's very familiar with HFA Advantage and very familiar with ADFA's program. So I would encourage you to make sure that you have this number Again, like I said, we're going to give you a copy of this presentation. If you registered, if we have your email address, you will get a copy. If you didn't register, if we don't have your email address, just reach out to us, reach out to Tim or myself, and we'll make sure that you get a copy of this presentation. But we want to make sure that you first press 1. You're going to enter 1 again, and you're going to enter 1 again. So it's 1-800-FREDDIE, and then 111. You are going to need to know what your salary servicer number is, because they're going to ask. If you don't know what that is, again, you can certainly reach out to me, and I'll get that information for you. But this team, I mean, they've been incredible. I know they've spoken to many of the loan officers that are in this room, and they'll review your LPA. Now, another thing that I want to mention is you can also reach out to me. But one thing I would say is please don't send me your LPA feedback certificate. You should know better, but in case you don't, it contains a lot of non-public information. It has their account numbers, it has social security number, and I've had loan officers email that to me. I don't have a problem with it, but your company probably does. They don't want you emailing that information, and I don't need the feedback certificate. All I need from you is the identifier number, the ID, the LPA ID. So if you send me your LPA ID and say, hey, I need help, I don't know why my loan's not getting approved, here's the LPA ID, I can go into the system, take a look at it, make some suggestions, or if we need to escalate it, we can have our underwriters take a look. Our underwriters will take a look and they'll give you a call. And they'll usually give you a call the same day, if not the next day. And they'll review that feedback certificate from top to bottom so that you understand what changes you need to make, or so that you understand at the very least so that you're not spinning your wheels trying to get a loan approved that's not going to go conventional. They'll clear that up for you and save you some time. So it's a great resource to have. I know, like I mentioned before, many loan officers have reached out to them already and have been provided with that additional level of service.